Well, excellent. Welcome, everybody. This is the part 5 of the institutional series. For those that are watching the recording, hope you're well. Hope your family's well. Definitely sending a lot of good blessings to you and yours. Today, we're going to focus on the macro times, which is going to cover both time and price. And again, the reason why we love this is because this gives us a tactical plan. And then on top of that, it gives you a specific time for you to focus. Everyone talks about trading, the EMAs, the double tops, the chart patterns, all these different things. But no one can tell you, listen, if you focus on 950 to 1010, that 20-minute window, within that 20-minute window, knowing the institutional concepts such as a fair value gap, such as a breaker block, such as an order block, all these different things, it will give you the opportunity. It gave you the opportunity to get a trade, And that's exactly what we're doing here when it comes to today. So drop a one if you're ready. Drop a one if you're ready. We're going to start off very, very slow. We're going to build up the foundation, and we're going to start from the market maker model. What does that mean? Why should we care for it? And then from there, we're definitely going to talk about what are the actual times that you need to know about that are going to get you to the next level. I can guarantee you, I personally know people that have fired their 9 to 5 using the last 4 classes that we just talked about, all those different institutional concepts. And then on top of that, using the macro times, this is really going to help you out. So let's go ahead and get started. Again, part 5 is you versus you. Please make sure that every single time that you're going against yourself, not the neighbor, not your ex, not a cousin, not a friend, make sure that you win every single time. So let's go ahead and get started. Why do we care so much about the market maker sell model or the market maker buy model? This is because this helps you understand that the market only does 2 things. I keep saying the same thing because that's the only thing the market does. The market either is going for liquidity or is trying to rebalance some sort of inefficiency or some sort of imbalance. Like, for example, a fair value gap or order block or breaker blocks. Those are the top 3 when it comes to the algorithm and the institutional algorithm that we go against every single day. Why do we care about macros? Well, the reason why we care about macros is because macros consider it a 20-minute window where we expect 2 things. We expect price to go after liquidity, which gives you a trade. We also expect price to come down to a fair value gap, either respected or disrespected, which then becomes a inversion fair value gap. These things will help you at least get anywhere from 20 to 50 ticks from NQ, from ES, from any indices that you see out there. You will definitely have the opportunity to do so. So just for better definition here, a macro is a period where the algo will seek buy-side liquidity, all right, sell-side liquidity, or it will seek to rebalance a point of interest between the open and the close of that macro. The macros happen every single hour, 10 minutes before and before the top of the hour to the 10 minutes after. So these are the ones that I really focus on myself. I really want you guys to focus on this part of the screen right here. These are the ones that I use every single day. Ideally, I really like, my favorite one is the 950 to 1010 in the morning. 1050 to 1110 in the morning is also really good. I honestly try to avoid the 1150 to 1210. Why is this important? Because again, if you guys really want to become consistent traders, you want to become a profitable trader, instead of winging it at any given time, right? You come in at 2:30 and then you over here trying to look for a trade, and now you're confused because you can't find that trade, or vice versa, right? Vice versa. Let's say it's the morning, 9:30. As soon as the first opening candle hits, you're already in a buy and a sell. You are setting yourself up for failure, and the only person to blame is yourself. It's not me. It's not the person next to you. It's not somebody else that you're here for when it comes to trading. It's yourself. So how do you eliminate the risk? Again, you want to diminish the risk, but you want to expand the reward. How do you diminish the risk? You diminish the risk by enhancing the focus. And how do we enhance the focus? Going after the times where the market, we know that more than oftentimes the market is going to do what? It's going to give you a trade idea because the market is either going to seek liquidity or it is going to seek a imbalance. So 950, 1010 is definitely my favorite one. 1050, 1110 is also a really good one. I've seen people play with the 850 to 910, but again, you really, really have to hone in on the one that you really want to do. And ideally, what you want to do is that you actually want to back test these different things. The top quadrant here represents the morning macros. The bottom quadrant here represents the PM macros. The 120 to 140 is always good money. 250 to 310, always good money. I really like this one, the 350 to 410, because that's always market close. At market close, price will always go after whatever liquidity hasn't been purged yet. And that's a gem right there. And you could just go into the market every single day at 3:30, mark out your liquidity points, mark out your imbalances. Okay, this was a sweep. This got disrespected. Trade plan. That's how easy it can be. On the right-hand side here, I do have a couple of other macros. These macros are actually by another trader called Hydra. Shout out to Hydra. He's been doing a lot. Yep, it's the 920 to 940. These are some macros that he was able to develop himself, and he was able to backtest them. I've seen him trade these different macros, and they're really good. Sorry. 950 to 940 is definitely my favorite. 1020 to 1040 is also really good, but I've seen him have the majority of success within the 920 to 940. Hydra's, he's good money, and I'm telling you, these trades are not trades that are 10 handles, 10, 20 handle scalps. These trades can result in 400, 300 or 400 ticks, at least 100 ticks per trade when you catch these trades and you're able to check the imbalance and everything like that when it comes to the trade. That's the result of having that happen. So I just want to show you guys quick here. Shout out to Hydra here for this graphic that he created. But this is exactly what a macro trade will look like, right? Of course, we always have some sort of manipulation. And what that means is that we break below a liquidity point and we fake people out. There's a whole bunch of people that got faked out right there, and they went for sales or short, right? What the market always do is that the market will always manipulate those retail traders, knowing that retail traders are going to continuously do those different things and do those different mistakes. Why do you think brokers are saying, yeah, we want everybody to trade? Yeah, they want everybody to trade because everybody does not know how to trade the market. And that means more liquidity or more money for the big market makers. So as we can see here, there's a couple of different things that I do want to highlight. The first thing here is that in this example, we can see that the market has here a form of liquidity. That liquidity was taken out by this candle. This candle formed a bearish fair value gap, and then we did a liquidity raise. Now, one of my favorite trades that I love to take is always an inversion. Inversion basically means that this fair value gap right here got disrespected by this price action right here, meaning that we got a candle that closed above the first low of that first candle when it comes to the fair value gap. That makes it a inversion fair value gap. And mind you, most people get in right here and you're able to make 50 to 70 ticks. But what's going to happen now is that this bearish fair value gap got disrespected. So this bearish zone now becomes a bullish, quote unquote, zone. So price will more than oftentimes make a higher high, and it will always retrace. And then from there, it gives you the opportunity for you to take that trade. But this happens between a macro time. The macro time was the vehicle that gave that basically caught the momentum and gave you the opportunity to get into a trade plan. Next, I have a couple of other ones here, 950 to 1010. And what do we see? We have here a fair value gap, bullish fair value gap. Right at 950, we got a bullish fair value gap. Price makes a higher high. And what do we see right here? What is price taking? Price is taking all these liquidity points, taken. And those are, at the end of the day, those are take profits. That's how we know how to tell you take profits. When I'm putting out those numbers out in the future signal where I'm telling you where price is going, I'm not getting that out of what is it? Like some sort of magic ball. None of that. I'm getting it based on the liquidity points that I'm seeing on my chart. What do we see right here? Within the 950, we see a liquidity purge. And what do we see? Every single line item that will give us the opportunity to understand that the market is going from bullish order flow to bearish order flow is what? It's getting disrespected. For example, this low right here, just this close below it, lets us know that price wants to go head lower. On top of that, we have this fair value gap that price goes ahead and does what? Disrespects it. That right there is your entry for a sell. And you can target this, and then ideally you can also target this right here. Just this move from here to here, that's over 100 ticks. With 2 full contracts on NQ, you're up $1,000 in minutes. And that's how you're able to refine your focus, by finding that time or those periods within the market that are going to give you the best trade idea. This right here is a afternoon example, 3:15 to 3:45. And as you can see here, what do we have? Within this time, we have a fair value gap. That fair value gap, the price is respecting that fair value gap. And as you can see that we had an instant pop to this liquidity point, to this liquidity point, and ideally back into this liquidity point. But this opportunity was only provided when? During the 3:15 to 3:45 macro. So you guys are probably asking, Chris, how do what do we look for? How do you trade this thing? Okay, cool. If I want to come into the market every single day at 950, what is the checklist that I have to have? Like, what is the checklist that I have to have? And what do I have to have in my chart that's going to give me enough narrative and context that I'm able to then go ahead and create that trade? So I'm going to quickly go back into today's example of how we traded the 950 macro and what gave us the opportunity to understand that we could have gone both long and also short. As you guys know, I scalp a lot. For me, even me getting 50 ticks, it's definitely a great trade. I try not to be the guy that tries to boost for 500, 700 ticks. I do not care about that. I care about just getting my slice, which could be 100 ticks with 10 contracts or 100 ticks with 5 contracts. It's still good money, right? So I really want you guys to always think about how would a portfolio manager go ahead and approach these different things. So here we go. And yes, Millie, yes, this can be on MNQ. This can work on gold. This can work on any indices, to be honest. Crude oil, ES, it could definitely work. Anything that has enough liquidity, this should definitely work. As you guys know, we are going against the algorithm. Once you understand the algorithm, times are definitely very, very critical and crucial. So here we go. So let's go back into the 1 minute time frame. And I'm just gonna go ahead and just jot 2 things down. As you guys know, I like to add my fair value gaps and things of that nature. But for this example, what I'm gonna do is that I'm just going to go ahead and mark out vertically the 950 to 1010. So here we go. So here's our 950 right here, right? And then right here we have our 1010. You can do this manually. I will also show you different ways that there's a whole bunch of different indicators out there that could definitely help you out when it comes to this, and can help you understand, automatically when these different macros pop up. But I'm going to go ahead and go before the macro and say the macro hasn't happened yet. And what can we see so far? Well, so far, what do we have? It's so basic stuff, but that give you enough narrative for you to understand how to actually go ahead and make that trade. And what do we see? We have a higher high, a lower low, and then we have a lower high. So right now we're definitely bearish. But aside from that, I want to understand, where's my liquidity? Where can price retrace to? Where are my imbalances? Where can price go to either fill or not disrespect a fair value gap? So I always go to the 15-minute time frame. I love the 15-minute time frame. And based off the 15-minute time frame, what can we see? Well, we can see that we still have liquidity up here that is still resting. We also have liquidity here that's also resting. Is this liquidity valid? Can someone answer me that? Drop a 1 if you believe that this liquidity is still valid. Drop a 1 if you believe yes. Drop a 2 if you would say, no, Chris, this is totally incorrect. That is not valid. There we go. Okay. I see 2. And the answer is 2. Why is the answer 2? The answer is 2 because, as you can see, every single candle, I really want you guys to pay attention. Every candle is doing 2 things. It's either purging the last high or the last low. Last high, last low. Last high, last low. I'm going to show you guys right now. I'm telling you, once you guys see the market as this, you guys will never go back to trading the retail bullshit that people teach. I can guarantee you this. Why? What happened right here? Liquidity got taken out. What happened right here? This candle right here closed above the last liquidity point, right? When we have a candle close above a certain high, the market is saying what? I want to go up. I want to go up. I don't care about nothing else. I want to go up. And I'm going to give the smart traders, the institutional traders, I'm going to go ahead and give y'all an opportunity to get in at a discount. So what do we have right there? A bullish fair value gap. What does price do? Price comes, fills it. You telling me right now, you telling me off a 15-minute time frame, let's say we got in this candle right here, right? Because that would have been the best entry. And you would have caught a buy right here. What are we targeting? Well, we could go ahead and easily target right here and make 210, or we can go ahead and easily target this last high and make 475 of a one single contract. And then what does the market do? Instant pop. Because the market wants to go ahead and do what? We are going ahead and we're filling internal range liquidity, hence a fair value gap, right? And then from there, we go ahead and we take out the last high. Did we get a price above? Sorry, did we get a candle close above? Drop a 1 if you believe yes. Drop a 2 if you believe no. Not at all. So what is that telling us? Price wants to do what? Come back lower. And every single candle, what is price doing? Taking out liquidity. What did price do right here? We took our liquidity on this move. What did price do right here? We took our liquidity on this move. Liquidity on this move. I mean, time after time after time, we are taking out liquidity. Price is leaving behind what? Liquidity points. So now that I'm here, right, and it's close to 9:50. Well, it's almost like 7 a.m. here. Well, 4:30. Here you go. Boom, boom. Right. Price comes down, goes up. What did price do right here? Price respected that bullish fair value gap. That's the reason why the price went back up. Right. Here we go. What did price do right here? Price went to do what? Take out. Let me put this over here. Take out this liquidity right here. What did this candle do? Take out this liquidity right here. What's still resting? Internal liquidity right here. So if price comes back down, where's it going to go? Right here. Simple. It's just simple. Boom. Okay. Took out this liquidity, took out this liquidity. Did we get a candle close below? That's how you understand candle science. Are we getting a candle close below, or are we just sweeping? What did price do here? Price went ahead and swept. Right? So now that I'm here, it's 9:30. Let's go ahead and let it play for 2 more. That's 1. Okay, here we go. 9:45. And what do we see right here? Price creates what? Price creates a bearish fair value gap. So now what are we doing? Now we can forget about this explanation here, because now we understand liquidity. Right? This liquidity got taken. This liquidity got taken. This liquidity right here is still an active liquidity. So now when I go down to my 1-minute time frame, I'm using my higher time frame alignment, right? And I got my 1-minute time frame. Now I can go down and I can see, you know what? Well, for us to go higher, what do we got to do? Can anybody answer me that? For us to go higher, knowing that we have a bearish 15-minute fair value gap, what does price have to do? Take a second, drop it in the chat, come off mute, whatever you want. What's one indication that we're going to go up higher? We got to raid the fair value gap. We got to inverse. We got to close above it. If no close above, no trade. Simple. No negotiating, no bargaining, none of that, right? And what do we see? We continue to have liquidity that's still behind. These are targets. So now I'm thinking, price goes up, we disrespect, and we come right back down, right? So now we are, what time is it? It's 9:59. We're now in the 9:50 macro. right? We're now in the 950 macro. And by the way, right at 950, you could have also gotten a trade. We called this out, and I'll show you how. Price is coming down. What do we see right here? We still have this liquidity point that's still active. What do we see right here? On top of that, we are seeing that a 1 minute bullish fair value gap just got disrespected, which is this right here. Got disrespected right here, making it a inversion fair value gap. We also have another fair value gap that just got disrespected. That lets me know that price is going to go down 100%. Just off this candle right here. I get in all the time. Listen, I can sustain whatever drawdown comes out here. That's fine. I come in here and that's easy money. What's that? 185? Cool. 185 in a minute. I think I could do that. Boom. 2 minutes. 185. Not bad, right? What gave me the indication that price is going to go higher? What gave me the indication that price is going to go higher is this. We never closed below this liquidity. So price just swept liquidity and we are coming back into the range. So that's where I get a buy signal. Really that simple. Mind you, 950 just started. I'm getting a buy trade, and I'm going to go ahead and just take, you know what? I'll take 210. Ideally, I should take this out here, this 260. And what does price do? Boom. Excellent. Excellent. Comes down. Okay. Excellent. 445, 2 trades within the 950 macro. Okay. Let's continue. Let's continue. Let's continue. Because I really want you guys to understand how we use liquidity and imbalances to find trades, even when we're consolidating. Drop a 1 so far if this is helpful to see it. Oh, yes, we're doing a back test, we're doing a replay and everything like that, but to see it using the 950, 1010 and just using just simple imbalances. I'm telling you, my godson, I teach him this. He knows how to spot a fair value gap. We should all be able to spot one and then build a trading plan around it. So off rip, I'm seeing that price comes in and we're rejecting off the 15-minute fair value gap. So I'm already thinking, you know what? Price is going to respect the bearish fair value gap, and then we're going to go ahead and head lower. We are still within the 950 to 1010 macro. I'm going to let one more go and let's see what happens. As soon as you see this lets you know that price can potentially go lower. The reason why I'm getting into a sell right here is because, yes, price did close below this liquidity point right here, letting us know that we definitely want to go lower. So again, this is time right now is 10:02. I'm going to put my take profit back at that low that's still resting. One contract, $455. We're up 445 so far. Let's see what happens. Price comes up, comes back to the fair value gap. Not panicking because we just rejected. And then on top of that, what gives me more confirmation? The fact that we closed below the liquidity level of the 1002 candle. This 1002 candle right here is a protected low. It basically lets us know that if price closes below that, we are for sure heading lower. So now I'm getting more confluence as price is continuing. That's why when I signal, I say, let's stay in the trade. If price is respecting the order flow, let's stay in the trade. And so far, price is definitely respecting the order flow. Here we go, easily. That's $900. 3 trades. I would say what? We started early. So within a 21-minute window, that's cool, right? What is my stop loss? Great question. Ideally, some people go ahead and they put it all the way up here. I know not everybody can sustain that sort of drawdown. Because again, if price comes up here, what does this make it? It makes a inversion, and price is basically letting us know that we have a reversal and we're going against the trend, right? So ideally, what I try to do, because I'm a scalper, I go in heavier. You got to think about what type of day trader you are. Like me, I try to go in with 4 to 5 contracts per trade. Ideally, I want to go ahead and scale up to 15, 20 contracts per trade. So I can't play these games of letting shit fly over here. Nah, I cannot do that. I have to make sure that my stop loss, it's super tight, maybe right above the 50%. If it hits my stop loss and it comes back down, I'm not gonna be mad at it, right? So that's something critical to understand when it comes to the 950 and 1010. Smurf, if you want to go ahead and just come off mute, I think that's a really good point that you just made when it comes to the equal highs and the fair value gaps.
What's going on, Chris?
What's up, brother? How you doing?
I'm cool, man. You know what I like to see? I love to see those equal highs at about 75% or 50% inside a range. I always measure.
Yeah.
So if I'm looking to see if price gonna reverse, always look for the equal highs, but I also look to the left to see if there's a 5 minute inversion that price hasn't traded into yet.
5 minutes.
That's the one right there. Anytime, listen, I'm gonna tell you right now. The price is always going to draw back into that 5 minute inversion inside a macro. I don't care if it ran 80 points up, it's coming back down. Like I'm a turtle soup trader, so I know. I do it all the time. People like, how you know that? Well, I back test and I see it every day. But you want to see equal lows. You want to see equal lows above your 5 minute bullish fair value gap or
Mhm.
whatever fair, but it don't even got to be 5 minute. And you want to see equal highs right below it because price is going to do is going to turtle soup those equal highs, hit that fair value gap, then it's going to go down to the external range liquidity that it left behind. So internal, external, easy money.
Mhm. Yeah. That's a phenomenal point. Phenomenal point. And again, you guys got to think about it. That's the only two things that price does is going to internal liquidity back to external. And then again, creating new ranges, new ranges, new ranges, new ranges. And that's why people ask Chris, like, what do you do when both buy side liquidity and sell side liquidity gets taken? Well, when these two levels get taken, it creates what we call a dealing range. So prices all it's doing is creating dealing ranges, dealing ranges, dealing ranges, dealing ranges until they hit their target, which is their major liquidity level, if you will. So thank you for that, Smurf. Appreciate you, brother. Questions or comments? We're at 6:30 so far.
Yeah, Chris, there was
Yeah.
actually one really good question that was in the chat. I answered, but I want to make sure we touch on it. When you were looking at the 15-minute time frame, the question was 15-minute time frame, is that the usual time frame to use this strategy? But I responded around, about the 1 hour and the 15-minute HTF alignment and 1 minute entry. So let's, I think, quickly touch on that because that's important.
Yeah, that's a phenomenal question. And again, time frame alignment is definitely everything. Like this is my setup every single morning. I don't change my setup. I do not try to change it at all. But how I have it, I have the 1 hour time frame. The 1 hour time frame tells me that higher time frame context and also narrative. And then from there, I'm able to get these major liquidity points. And then here I have my 15-minute time frame. And then lastly, I have my 1 minute, which I do go back and forth between the 1 minute and also the 5 minute time frame. And like Smurf said, the best inversion fair value gaps will happen on the 5 minute time frame, 1000%. And what I like to see is that whenever I get into a trade, I want to see everything in alignment. Like I want to see my 1 hour supporting my trade. I want to see the 15-minute supporting my trade. I also want to see the 1 minute time frame showing that price is still respecting the order flow at the end of the day. But if you're a scalper or day trader, I think that this is a really good time frame alignment and you're able to catch. I mean, catching 50 ticks is that I mean, that's a layup. Like when you have this and you know liquidity and you know about these different institutional concepts, I will say 1000% you'll be able to catch these trades every single day, right? So having as Late just mentioned, having the higher time frame setup here, well, context for setup, this gives you the setup. And what do I mean by that? So let's go into a quick example real quick. Just the fact that, let's say, for example, price came here, and this is a bit of a turtle soup, sort of, but price just swept out this liquidity. This lets you know from the higher time frame that price wants to head lower, right? Once we go ahead and we find and we have that higher time frame context or setup, that's when you will go ahead and then go into the 15-minute time frame or the 1 minute time frame for your entry. So something can be like, for example, let's say, let me find a better setup here. It could be this right here, right? Price, we had expansion all the way to the highs. Price does what? Price goes ahead and comes into the fair value gap. So it fills the fair value gap, is using the fair value gap as support to continue heading higher, right? That's an imbalance. So what do we see? 1 hour time frame, we close above. What does that indicate? it indicates that price wants to head higher, right? And you have all your TPs right here. TP1, TP2, whatever, right? But at this point, you want to go ahead and you want to go down to the 15-minute time frame, right? And on the 15-minute time frame, what do we see? Well, we see two things. We see that on the 1 hour time frame, price just went ahead and we just filled the imbalance and we respected it. What did price do here? Price took out this liquidity, and then on top of that, we also came back down into this bullish order block. This right here is a order block. I don't care what anybody says. That's an order block, right? So whenever you have order block and fair value gap and a sweep of liquidity, what is that telling you? Let's buy. We buying, baby. We are buying. And I'm going to go ahead and put my take profit. Yeah, you could take partials here, or now you could take it all the way to the top. I'm just going to take it right here to the 630. And let's see what happens next 15-minute candle. Boom. So that's how you're able to go from setup down to a smaller time frame for a actual entry. Drop some one if that's helpful. Questions, comments, bring it on. I still have more stuff to cover, but definitely wanted to cover this for sure.
Hi, Chris. This is Jen. How are you? Hi, everyone.
Jen, what's up? How you doing?
All good. So, but you wouldn't hold that trade for 15 minutes.
I mean, ideally you would hold it. Yeah. Like, look how it looks on the 1 minute time frame. 1 minute time frame, you would hold that trade on the 15-minute time frame, 100%. Oh, ideally you could take partials either way. I mean, you could definitely take partials on the way of price going up, but ideally what I try to do is that I try to take profit at my target. I try my hardest. Sometimes I'm up to a point where I want to go ahead and just click on sell and just, take profit, but I try to stay militant to the plan for sure.
Okay. All right. Thank you.
You bet. You bet. Any other questions or comments? All right, let's go ahead and continue. So that's the 950 to 1010 macro, as Smurf just said. There's also the 920 to 940. Those are really, really critical as well. And guys like Hydra trade that stuff every single morning. I want to go back and I want to show more in depth what the actual stages of manipulation and the PO3 actually stands for when it comes to trading. So let me go ahead and get a second here while I change monitors, and let's go in a bit deeper when it comes to how we're able to do these different things. Lastly, before we go ahead and cover that, I do want to cover this real quick. This is the 950 to 1010. This is another example that I quickly want to go over, and hopefully it's a recap for those that just saw the examples that we just covered, and maybe you're a bit new when it comes to this. If you do not know what a fair value gap is and you're on our fifth part of the Level Up series, I highly, highly recommend you to go back. I'm not just saying this to say this. I mean, you guys can vouch for me, those that have been here for all 5 classes. There's no program out here that does this. I can guarantee you that. There's no program that does it for free and is giving you guys all these different insights. I want every single person to win. The market has money for all of us. It has trillions of dollars, and we just got to go get it. So if we can work together, I think that will definitely be a good plan for everybody in the entire community as well. So let's go ahead. So this right here, we see that we are on the 1 minute time frame prior to 950. By the way, 950 starts right here. It starts right here. If you know what's good for you, I love it. 950 starts right there, right? And what do we see prior to 950? This was a fair value gap all the way up here. And price comes what? Price fills it all the way to the top, but we still reject off the fair value gap. Aside from the fair value gap being created, which at the end of the day, this is just a lower high that was being created. We have back-to-back fair value gaps. And what do we see? Now, this becomes a fair value area. We have an entire area where we have back-to-back fair value gaps. And what do we see right here? As soon as that happens, price closes below this fair value gap, or these two fair value gaps. Hence, price is disrespecting price. This bullish zone now becomes a bearish zone. Price comes and it respects the 50%. That's all the way easy money, and was able to take that down to the 830 low. That's 300 and something ticks that you're able to catch within these different macros, right? So it's super, super critical for you guys to understand that it's not just the macro, it's how do you put it together with the concepts that we have covered, including both liquidity and also the imbalances as well. there's different types of macros, and this is a bit more advanced, but I definitely wanted to cover it today. And by the way, I will be sending out just quickly. Let me do a quick test real quick. Can everyone access the link that I'm going to paste into the chat real quick? I am very sorry about what happened with the Miro dashboard. They started to limit people's access and stuff, and that's when I said, you know what, I'm just gonna go ahead and go back to Canva. So I do plan on taking time this weekend to transfer over all that content into Canva, and I can guarantee you, I will say this again, and I will not stop saying this, you will become profitable. If you listen to what I'm saying and you listen and you go back and you back test and you look at these different models, there's no way that you will not become profitable. You will become profitable. And once you become profitable and once you realize that you are a walking ATM, life is going to become a lot easier. And then you're able to do whatever you want with your family, buy people stuff, financial freedom, and do the whole nine. Okay? So here we go. This is the last concept that we're going to cover. And then from there, we'll just open it up for questions, just quick Q&A on absolutely anything, just giving 10 minutes so that everybody can ask questions. And then we'll just go ahead and just finalize it there. The first macro, there's 3 different types of macros. There's first the accumulation macro. The accumulation macro is where the macro creates liquidity. And once it creates liquidity, all this means is just consolidation, right? Whenever you see a macro that just consolidated, basically you want to go ahead and you want to skip trading those macros. Not every time, every single macro is going to give you a trading opportunity. But me personally, this is just my personal opinion. I truly believe that if you understand imbalances super, super well and liquidity, how we explain it, you should be able to trade this. Like today was definitely a bit of a choppy day in the morning, and we still ate. I'm talking about every single person in the future signal chat ate today, and we caught hundreds of ticks today, right? So the first thing is the accumulation macro. Then we have the manipulation macro. The manipulation macro, this happens all the time, especially during the New York session, and you will definitely see this happening. So what happens? Price is either going to sweep sell side liquidity, basically, quote unquote, a support, right? So price will sweep it when it wants to go up, and price will take out buy side liquidity, aka resistance, when it wants to go back down. So as you can see here, I'm going to quickly just zoom in to this example. What do we see right here? We have an entire place of liquidity right here. What does price do? Price goes through it. It comes back down during a macro time frame. And as you can see here, all these fair value gaps are getting disrespected. This right here would have been an easy sell back to the bottom, where we also had liquidity that was also resting. That's why I really want you guys to get to the point that as soon as you guys get onto a chart, I want you just to go ahead and mark out where your liquidity points are at. I'm also building an algo alongside of the rest of the team that's going to do this for you automatically as well. But that right there is called a manipulation macro. Basically, when we fake traders out that we're going bullish, and instead what we do is that we purge it or we just sweep it, and we come and we target the opposing liquidity, which will be that low. Next, we have here expansion macro. So again, the market moves in these different phases: accumulation, right? Manipulation, and then it goes into expansion. Expansion is basically where now the market has exploded towards a certain side, and there was a certain form of sweep when it comes to liquidity. That's why even if you guys really want to get to the next level, wait for a liquidity to be swept. And I can guarantee you the market will give you a trading idea. Let's go back to the chart. And it's the last example that I'm going to show. And then from there, we'll go ahead into quick Q&A. Just quick second. So today, 9:30 was a clean open, just because it did provide a good amount of opportunities just by us knowing what the liquidity was for the London session, right? So let's go ahead and take a look at that real quick. All right, here we go. So let me go back to the 1 minute, right? As for those that have the reserves, use it. Use it. We gave it out for free. There's no reason why you cannot use it. You should go ahead and use it. Why? Because this allows you to understand exactly what price is going to do. And what you're going to see here is that if I take off absolutely everything here, and I go back, let's go back here. Here we go. Boom. Here we go. So this is what happened. The reserves indicator gives you the opportunity where automatically it plots out the London high. Why do we care about the London high? Because that's liquidity that is still resting. And at 9:30, price is going to go right after that liquidity. I'm going to go ahead and just quickly zoom in. What happened right here? Is that a liquidity run or a liquidity sweep? Drop a 1 if you believe sweep. Drop a 2 if you believe run. Right here. That is a liquidity sweep. Price swept out that high. And we never got what? We never got a candle close up here. If we had a candle close up here, well, we may go higher and price will give you a discount where you're able to get into that entry, right? But what happened right here? We swept liquidity, and I'm going to show you guys how surgical I really want all you guys to get. It's not just me. It's not just a team. We want you guys to become super surgical where you're able to pass this down generations. That's the key when it comes to all these different things. So here we go. That's a sweep right there. What's this right here? Can someone remind me? When a red candle closes below a green candle, what does that mean? Anyone? Why do we care about that? I'm going to put it onto the chart here. Why do we care about that? That's also an order block. Changes state of delivery, which is also a order block. But phenomenal point. Yes, that lets us know that price is going to head lower. It's really that simple. And honestly, we could have taken a trade just based off of that, right? This is the order block. Let's say, for example, just real quick, because I really like to get surgical with this stuff. Let's say we would have gotten into a trade right there, a sell right there, right? And we let one candle just fly, right? One candle. We already up 275 right there. How many of you guys taking profit right there? Drop a 1 if you're taking profit. Drop a 2 if you're not taking profit. And it's okay. It's okay. Listen, we all learn together. Okay? Not yet. Anybody taking profit? I might take profit. Take the 275. Go out to dinner. Get Peruvian food. Why not? Why are you so sure, though? I want you guys to be sure. That's an order block. I could care less. I could care less what price is going to do. I know that price is going lower. I know. And why should I not be scared of this candle? This is how you take it to the next level. I know that this is my line of defense. This right here is a order block. That's a bearish order block. Price cannot come into this area. There's no way. Price cannot come here no more. That's it. You are basically showing me your hands. That's what the market is doing if you learn the institutional concepts. That's an order block. And price did what? Price respected that bearish order block. Shark, tell him. Yo, Shark, tell him. 275 times 100 is $27,000. That's good money. So now that I know that, I'm going to double down. I want one more. And what does price do? Boom, boom, boom. Up 1,000, up 1,300. You're catching ticks. Look at that, $2,000. And this is the only time that you should feel somewhat, you know what, I should get out. Why is that? Why should this be your exit? Thank you, Smurf. Thank you, brother. Appreciate you. Why is that? Candle closure and changes state of delivery. What are you talking about? Come on, now we do this. So now we put a whole rectangle. That's a whole order block. So let's say we take profit right there. Mind you, I don't even know what's going on at this point, right? I'm right here. Price can do what? Price can use this order block as a way to get head up higher. Let's see what happens. Or if not, it just goes lower. And on top of that, we got a fair value gap too, which we also got to take into account. But we got a body closure above it. You see? Let's see. Let's see. Look at that. That whole area got respected. That whole area got respected. We pop here. Let's see here. Boom. Just a little bit. And that's when we ranged and we came back down. But that's why that 930 is super, super important. And by the way, today would have been 950. Okay, so if we put 950, 950 to 1010. Was it accumulation, manipulation, or was it expansion? Accumulation, accumulation. We consolidated. We consolidated. And here's what you could do too. Let's say you don't even mess with anything else when it comes to trading, and for whatever reason you want to be stubborn, right? Because they are very stubborn people on this planet. Let's say you want to be stubborn. You say, you know what, I don't care about the 930, I don't care about nothing else but the 950, 910. Okay, cool. Then you just take the highest point. You take the lowest point between the 950 and 1010, and those are your liquidity points. Dead. Those are your liquidity points, and let's see what's going to happen. What does price do? We close below it. What is that letting us know? Anyone? Okay. Well, come back up, come back up. And that's because it came to the order block, by the way. Boom. But I want you guys to get to the point that you know why price came down. Price came to an order block. Price came to a fair value gap. We were in a accumulation 950, 1010 macro, or the 315, 345 was expansion. There's so many different opportunities. So many different opportunities, you know? And I do want to share this real quick. I'm going to go back into the Canva real quick. I want to give you guys the macro times when you guys trade the FOMC. Drop a 1 if you guys want to see that. And yes, there's a whole bunch of opportunities too when Powell was speaking. Drop a 1 if you want to see that. People don't really talk about FOMC just because it's so risky. I still believe that it does provide a great opportunity. So let me quickly go to my notes because I do not have it on the Canva. And these are the times that I really want you guys to hone in on when you guys do trade the FOMC. So 1 second. And I'm also going to show you guys a trade example that we took as well. And we also signaled in the chat. So here we go. This is the protocol for FOMC. Here we go. These are the macros that I really want you guys to focus on. 250 to 310, 320 to 340, 350 to 410. And a really good point by Shark. He said that people are scared to trade FOMC, but I like to trade it. I'm gonna tell you something. Even when Powell's speaking, the algorithm's still going. It's not like the algorithm like stops for Powell. No. It's still gonna do the same thing. Internal range, external range, liquidity, fair value gap. Fair value gap, go to an order block. You know, all these different things. Let me show you guys the one that we were able to call out today. So here we go. So macro started right here, 1510. Right? So 1510, we're gonna go ahead and take this. Sorry, 250 to 310. And let's see what happened right here. Price at this given moment, by the way, I was on the 30-second time frame right here. And as you can see, this looks like a double top. What this is, it is indeed a double top, but this is a failure swing, right? Failure swing because we weren't able to take away the last high, right? Which will make it a break of structure. So we failed to break structure. So that's the reason why price went down, right? So aside from that, what do we have? Fair value gap. What do we have right here? Protected low. What does that protected low mean? That protected low means that if we break below it, price is telling us where to go. Price is telling us that we want to go low, right? Price wants to go low, but we got to be the ones to say, you know what? What's going to be the perfect entry? So now that we know that this fair value gap got disrespected, this becomes a inversion fair value gap. And what does this candle do? It fills it, comes back down. Honestly, any of these entries, as long as you're able to sustain this and you're able to understand that aside from it being an inversion, what do you have right here? Can someone tell me? What is that right there that I just colored? This right here. Anyone? That's a bearish fair value gap. And the candle went right to it. And this would have been at least 200 something ticks back down to the previous day low. That's how you're able to use these times with the same concepts that we have used. These are the times here for FOMC: 250, 310, 320, 340, 350, 410. Drop a one. How do you feel? Tell me. I really want to get your feedback when it comes to these different things. Like I say it again, you will become, there's no way you cannot become profitable with this. There's just no way. Something else that I really want to show just quickly, I did not plan this for this class. And matter of fact, I'm going to go ahead and just stop the recording right now. For those that are watching the recording, and continue. That's my biggest recommendation to you. Continue, don't give up. This is a beautiful journey when it comes to trading. It takes time, but that's the process. That's the process, and it's so beautiful. There's so much magic in it, and we're giving you guys all the exact blueprint on what we use every single day to get paid every day, and to also learn how to dominate the market every single day. Blessings.